Hi everyone, this is Rob Roy, and welcome to Elliott Wave Options TradeFinder Live. As a reminder, we need to go through and do the disclosure. So if you haven't taken a screenshot of it, you might as well go ahead now if you're new with us. This is part of the regulations. We show you this each and every week. I'm not going to read the entire thing to you, but the two most important things to be aware of is that we are not registered to give investment advice in the United States, and any prices that we talk about will be denoted in US dollars unless noted otherwise. So those are the two primary things they want you to know. So take a screenshot of it, take a read of it when you get a chance. If you are new to TradeFinder in this broadcast, what we're going to do is go through, look at the market. So always start off with what's happening. And if you've been watching any of the videos, you know that something significant happened today that we've been talking about for weeks, really. So we'll go through that. Then we'll go to our website and take a look at a case study that is actually one of the alerts that we send out to our subscribers. Once we go through that, then we will take a look at search results and see if we can come up with a case study to look at for this week. We'll review the one that we did last week. We've been on one heck of a run since we started this TradeFinder series of I mean, you would have, if you would have followed along with them, you would have done really well. So we'll take a look at last week's, and then we actually ended up sending that one out as an alert to our subscribers as well. And we'll see what this week looks like, and then we'll wrap things up with some questions at the end. So that's the format, and appreciate you spending some of your valuable time with us. Let's go ahead and take a look at the market. And I need to switch this over. Remember, I am trying to learn ways to make your viewing experience better. So hopefully you're seeing the chart of the SPY on your screen now. Hey everybody, seeing your comments. Good to have you. Everybody seeing that? Yep, cool. All right, so we've been talking about this for quite some time. We've been going sideways for better than a month. Then we moved up to the upper end of this range. A couple of things that will show you if you are new and haven't had a chance to see this before. The market was really going sideways at this 61.8% fib level right here, a major fib resistance support level. So not surprising at all. You can see we bounced off of it twice. Coming up here, hitting it, bouncing down to the previous level, back up, tested the previous level again. Looked like we were going to break down below it, but closed back above it, gapped up to that level. And I thought we were going to have another gap today. You can see where we opened, but the market did trade down enough to where it closed that gap. So having two gaps here below would have felt pretty confident that, hey, this is going to run out of gas and we're going to head back to the downside. But we didn't. But the main thing we did is we, one, tested this 200-day moving average. And if you watch the intraday movement of the market, we did sell off towards the close, still finished up for the day, but about half of where we were at one point of the day, especially with the open, as you can see. But the thing that I've been watching and talking about is this gap here that's been in the market ever since we started to the downside way back in February. So we came all the way down, we moved back up, we've been going sideways. We are in a qualified, still in a qualified downward zigzag pattern, meaning that this is the A and that's the B. And so the expected move would be to the downside. Even with this move above where this B is, it's still qualified. It won't become disqualified until we hit 78.6% fib level, which is right about here. If that happens, then the downward move becomes disqualified, and we have a very high percentage chance, as difficult as it may be to believe, and maybe that's the reason it happens, we're going to go test those highs. I would feel extremely confident that that's what's going to happen if we do trade up to this level. And you might think, well, yeah, there's not a whole lot of room to go. That's over 200 points in the S&P 500. So if you can't come up with a good trade with over a 200-point move in the S&P 500, then something's wrong. There's plenty to make a really nice trade there, plenty of room if we hit that level. We're not there yet. We took out one thing that we've been talking about as far as the list of where the market could go for quite some time, which is that gap. So the gap's been closed. There are no gaps in the way. So the market could, at any point in time now, start to the downside. And one last time, just to make sure that I'm very clear, because one thing that I've noticed by doing these webinars and posting, or excuse me, these recordings and posting them on YouTube is people tend to hear what they want to hear. And you look at the comments and it's like people make comments and one person heard one thing and one person heard something else. So you know that own personal views are being wrapped in there, and obviously the wanting to prove the other person wrong, just the mentality of people, humans, plays into the mix. But we got that gap closed, so we'll see how the trade plays out. It was interesting that we didn't close above the 200-day moving average. Is about the only thing you could find interesting about that. So what do we want to see? When we have a move like this, it's kind of breaking out of this range that we've been in for a while. Obviously, the first thing you want to look at is, was there volume behind it? And we didn't make it to the 200-day moving average as far as considering average volume, but it was better volume than we've had in a couple of weeks, where the volume has been steadily declining. So from that standpoint, you can see that there was a move, and quite often strong impulse moves come from below average volume, and then the volume kicks in. I think there's probably a lot of shorts right now that are watching exactly the things that we're talking about. We are not the only ones that talk about the 61.8% fib level. There's a lot of program trading that is focused on that level because it is such a strong support resistance level. And we could spend hours talking about why. What's the math behind it? What's the psychology behind it? Is it just a self-fulfilling prophecy? All those things that people talk about. In the end, it doesn't matter. It works as support and resistance. That's what matters. And the program traders program their patterns, their programs, if you will, the buys and sells based on these types of scenarios, these levels. So I'm sure the shorts are quite nervous. And if we are able to close much higher than here, then I think, yeah, we're probably going up to hit that 78.6, and we're probably going up to test those new highs at that point in time. So the next couple of days, if the market doesn't start back down, is going to make the shorts very nervous, and they'll cover. That'll ignite another upward move to the upside, and we could retest those highs in relatively short order. So there's talk about and we were chatting about this before we went live, is that the media has to come up with some reason why the market did what it did every day. There's always a headline. The market did this because of. No, it didn't. It didn't do that because another company came out and in the very earliest of trials had some success. It's way away from a vaccine. Now they may very well have a coronavirus vaccine in record time, faster than any other vaccine has ever been created. But it's not going to be next week, and it's not going to be next month. It's a ways down the road at the very best case scenario. So that isn't the reason the market moved to the upside, because they used that as an excuse the last time another company said they had early success. It's too early to know whether or not it has any effect on preventative measures, or, I mean, they're not even sure about that hydrochloroquine or whatever the hell the name of that stuff is. They don't even know for sure if that stuff works. There's debates back and forth. So anyway, it gets frustrating when you watch the media headlines and one day we went up because of something, the next day we went down because of the exact same reason. It's just they have to tag a headline to why the market did what it did. Why can't we just say the market went up and leave it at that? Why does there have to be a reason why the market went up? I just don't get it. Anyway, all right, off my soapbox. Let's move on. So let's take a look at the DMI, because this is something that's interesting too. I made a comment about this in the last S&P update recording, that the ADX was just not interested in this upward move at all. From coming off of these lows all the way up here, the ADX just really has been working its way down, and the ADX is a sign of the strength of a trend. So it was showing absolutely no strength at all. Well, it's taking a peek now. Okay, so with today's move, it's actually saying, let's see, is there anything behind this? So we're not to a point yet where it matters. It has to close above this red line. The red line has to stay below the green. So there needs to be separation between these two, and the ADX needs to be moving up and close above the red line between those two. That's where the signal is in the DMI. If you participated in our trade scan web series, you know exactly what I'm talking about. So that's how the DMI works. So the fact that it's just ticked up a little bit is completely meaningless, other than the fact that it looks like it might be, you know, we had a couple of those here and then it rolled over and went back down. Could be doing that again. But just wanted to point that out, that maybe we're seeing something here out of this move. But I think the next two trading days, and I know I say this a lot because every trading day is interesting to me. And I always say, well, tomorrow's trade is going to be interesting. They all are. Every day is. But especially now that the gap is closed, we've tested the 200-day moving average. Now the rubber really hits the road. So the next couple of trading days will tell us a lot, in my opinion, of whether or not we go test those highs, or does that C wave extension start. Last thing I wanted to show you also was part of our Trade Scan web series is the CCI. And you take a look at this, and it's in the upper end of the range recently. But one of the most important things to look at with the CCI, if you're using that as an indicator, is history. Where has it been historically? So you compare the moves high or low, where it's been historically. So right now, it looks like, man, we're right back near those recent highs. This upward move doesn't have far to go. But let's go ahead and condense it down. And you can see that, well, that's one too many. You can see that that's been true for since 2019, the past year and almost year and a half. It is in the upper end of the range. But if we go back into 2017 and 18, you can see that those highs were considerably higher than that, actually getting up to the 300 range. So you can see the difference right here between these two highs. And that matters. It matters what happened recently over the last year and a half. So this is a pretty strong area of resistance as far as the CCI. But if it does break above that, it's got a pretty clear shot up to here, which would be, again, more energy and information for unexpected continued move higher. So we're going to learn a lot in the next couple of trading days. Does that ADX continue up? Does it get between the two directional indicators? Does the CCI break above this level and head up towards that 300 level where it was back in 2017? Those are answers that we'll get very soon, and they're going to help us a lot with where the market is likely to go from here. So pretty interesting as far as little bit increase in volume, little bit of interest out of the technical indicators, the supporting technical indicators, and we'll let the market tell us what it's going to do, which is the smart way to trade. Because the market doesn't care what we think, and it's going to do what it's going to do anyway. So I thought you might find that a bit interesting with the closing of that gap that we've talked about. I know some of you had already made comments after we posted the video last night. Before the market even opened, we're watching the futures and say, yeah, it's going to close. The gap's going to get closed in an hour, et cetera. And yep, it did. The only surprising thing to me today, out of everything that happened, the only thing that was a surprise is that we didn't have a gap up. I thought that gap up would hold with the strength of the futures throughout a good part of the day yesterday, especially into the evening last night. And so anyway, that's where we are, and we'll do a couple more market updates this week, I would imagine, with the fact that we didn't do a lot over this time frame when the market was going dead sideways, because it just wasn't a whole heck of a lot to talk about. But we will look at that further. All right, last week we looked at TSM, was the official case study. And if we take a look at that, you can see that it did move to the upside today. So it is a triangle, and we did send this out as an alert to our subscribers, as I mentioned. And we look at this, and then we talked about, well, the fact that we broke here, we went down, we went back up, we went down, we went back up. So we really didn't get the confirmation of the downward move. Did it again, going down on Friday, back up today. And so one could make an argument that this is where the expanding size of the triangle is not an expanding triangle. That's the opposite direction, but the expansion of this triangle would be a better word. is occurring, and that would actually be the point. I don't think you could argue with either of those two drawings as far as which one of the two is the triangle. It's still a symmetrical triangle, regardless of where you decide to draw the lines. There is a little subjectivity to drawing the lines along these patterns, but we're right back towards the point, regardless of which one on the breakout. So we haven't had a significant breakout yet, but that stock can really move, as you can see. It doesn't really sit still for very long. Back in 2018, went sideways for a little while, broke up, broke down, broke up, broke up, little sideways. It likes to move, and that's an important piece when you look at these triangles. And our next web series that we're going to do is going to be focused on Elliott wave. So we just did the trade scan series on the confirming indicators. Next up will be focusing on the intricacies of Elliott wave and taking it farther in some places that aren't commonly referred to. Other people, we're not the only ones that look at particular things, but that aren't commonly referred to within Elliott wave that I think are important, that Elliott thought were important. And we'll talk about some of these things with these triangles and the rules. And one of the rules of the triangles is if you're going to have a consolidating triangle and you're expecting the stock to break out, you'd really like to have some history that shows that the stock breaks out, that it's broken out in the past, that it moves in the past. And if you don't, then that's not a very good particular pattern to look at. So not a whole lot to report here, but feel pretty confident that when it's ready, it's going to make a pretty significant move. I did want to show you, this really isn't part of the plan curriculum, but the metals were interesting today, so I just thought I would bring that up real quick. We'll probably add this into the next update, especially with gold. You can see gold actually opened lower and finished lower. Silver was doing better on the open and then sold off once the morning started. You can see we actually opened much higher on SLV and then sold down. And if you take this bar away, and you can do that by just going back here, you can see on Friday that this is, I know this is stretching it, but it's still there. A little, not very well formed, but a small triangular pattern that is indicating some sort of a breakout move. And then you can see today we opened, looked like we were going to go higher, but in the end, all we did was close this gap. You see that? We closed this gap that existed right there in the chart. So we closed that, and then we came back down and are right back into that point again. So no breakout today. It looked like maybe it was going to happen at the open, but as the market continued higher, the metals sold off. But that's still right there smack in the middle of the point. So it looks pretty good as far as where things could continue from here. So just wanted to share that with you on the metals, because there's always a lot of chatter on gold and silver, etc. You know, we've been talking about SLV because the percentage move has been better than it has been on GLD. A lot of people trade gold, not as many people trade silver, but the silver market has been catching up to where gold's been. That's common, happens all the time. So the percentage moves in the SLV have been higher than the percentage moves in GLD. And that's, again, because it's in that kind of catch-up mode. All right, so let's take a look. Let's go to our website and show you, probably going to go through two of them. We didn't actually close anything from last week, so I thought I would go ahead and show you something that was open today that we thought about closing but didn't. And see if I think I need to change this again. I'm getting there, I'm learning. So here's the trade list of our website, and this is trade ID number 216 that I wanted to show you. You can see it's up 34%. And on these strangles, so here's the entry of the position. Here's the chart. You can see that we clearly had a symmetrical triangle. Talked about this before. They're my favorite pattern when you have a big vertical move and then you have a symmetrical triangle of the consolidation following that move. So it can be a vertical move to the upside with a symmetrical triangle, which a lot of people term that a flag pattern because it looks like a golf flag, or I think of the traditional flag is when it's vertical and then has more of a rectangular pattern after it, kind of like a sideways pattern. But people vary in their definition. So I call it more of the just traditional symmetrical triangle following a big run up. Same thing to the downside. You have a big vertical move, then you go through a symmetrical triangle. Those patterns, once they're ready to break out, tend to really break out significantly. So that was the setup. That's what we were looking at as far as the move. And you can see that we did an August strangle. Look at the width of the strikes, 105 and 60. This is where a lot of people get caught up in the idea of a strangle, thinking that a strangle is not as good of a straddle because of the fact that you're placing the options out of the money. And if the stock moves, it has to move so far before the position would become profitable. But that's actually incorrect. That some people still feel that an option needs to move in the money before it actually makes money, not realizing that you can buy an option out of the money, and if it makes a move, it's still out of the money, but your position is profitable. In other words, if you have the stock trading at 100 and you buy a 110 call, there's a lot of people that think, oh, well, the stock has to get up above 110 before that call is going to make money. Now, if the stock moves from 100 to 101, that 110 call is still going to make money based on the delta, the Greeks, everything else. Just depends on where they are. Still going to make money. Same thing works with the strangles and the fact that we take advantage of the delta curve, big lazy S curve, and gamma, which is the speed of the delta move, and we place our position accordingly. Then there's other things that factor in. Pricing of the options, implied volatility, open interest, all those things go into the mix as far as where we pick our strikes. But when you're looking at that and you're thinking, okay, the stock's trading at 82, 83, and you're at 105 and 60, there's no way that stock's moving that far to make money. Doesn't have to. That's the point, is it doesn't have to move that far. So let's take a look at where we are today in MHK, and that's where I can show you the fact that we had that significant move and we're at over a 30% gain. Now, one thing to remember is the average pricing or profit targets in these strangles, the way we talk about them, is about 30 to 70%. That's where it runs. That's just the average. The low end's around 30%, the high end's around 70%, and you're usually somewhere in between. Because remember, you're buying a call and buying a put. So when the stock breaks out, one option's making money, but the other one's losing money. So they're countering each other off a little bit. But you've also put a lot of factors in your favor because you don't have to pick the direction. You don't care which direction it goes. You just want it to move up or down. Just pick one. So the fact that we're picking the direction out of play, you're obviously, it's all risk reward. You're taking less risk, then you're going to have a little less reward to go along with it. So that's why it's kind of 30 to 70%. Every now and then you'll hit about 100% gainer. When you do that, you're happy. Those are rare. You take the few that come along, pardon me, and then move on. So here's the breakout move of MHK today. And the reason, I think, acting like the media, everything has to have a reason, right? It can't just be that, we were in a technical pattern that is forecasting a breakout move. That's not good enough to the media. You have to have a specific reason, all right? Well, if you need a reason, MHK is carpet. They make carpet. My grandfather actually owned a carpet mill when I was just a young kid, so something that I have a little bit of familiarity with. But the housing numbers came out today, and they were a lot better than expected. I tweeted this out. I don't know if you're following me on Twitter, but I tweeted it out when the housing numbers came out because it was a big shock. The new home starts were up, or excuse me, new home sales, make sure I get it right, new home sales were up 0.6% when they were expecting about a 22% drop. Massive miss, if you will, on the expectations. So the new home sales were far better than expected. So, what do people need when they're building new homes? Well, they need to put carpet in the new homes, right? So you can make the tie there as maybe that's the reason that the stock moved to the upside in today's market. Maybe just moved up because the market was up. Maybe it just moved up because it's in a pattern that shows it's going to break out. So I don't really care what the reason is my point. But, I'm being a little bit facetious here with picking on the media with everything has to have a reason rather than sometimes things just happen because they happen. But you could view that as a particular reason. And just to follow up on the housing starts, a lot of people, there was a big topic of conversation on the financial networks is how in the world is that possible? Well, mortgage rates went down and the pricing of homes went down 8.6%. So there was a big drop in prices and rates went down. So you can buy a home at less money and even further less payment because rates went down along with lower prices. So you can see how that could spike demand, right? Is it going to last? Well, we'll see in the coming months. It may be a very short-term temporary thing, but it was a big surprise today and it was chatted about a lot. So I usually try to expand on things that are focused in the media because people catch headlines and maybe not know what the full story is behind them. So why didn't we close this out? Because when we're in the trade just for a few days and we get a move that moves into our 30 to 70% profit range, and we're apt to go ahead and close that and take it and say, hey, didn't necessarily expect it to break out this fast, but we're happy when it does, and let's take that and move on. But didn't do that in this case, and here's the reason why. Now, we can look back at this and the stock's back down $5 tomorrow and you say, well, you missed an opportunity to take a nice gain. That could very well happen. And it is against what I normally do. But looking at, here's a gap, and you know how I feel about gaps getting filled. There's a gap that hasn't been filled yet, which is not that far away from where we are, especially with the fact that this is a volatile stock. And that plays into it as well. This stock moves. We've traded this before, sent out alerts on this before for our subscribers. And you can see that, especially on earnings reports, it really takes a move. There's a big gap down. There's a big gap back up on the next earnings report. So a gap down on this one, gap back up on the next one. But then you can see here's a gap down on earnings. There's another gap down on earnings. But look where this stock was not all that long ago. It was nearly a $300 stock. And now we're down at 80. So we're way, way off of the lows. The market has been playing a lot of catch up. I think you would agree that there have been, if you watch individual stocks or you watch sectors closely, yeah, this move off the bottom started with the big ones, right? Amazon, Google, Netflix, those are the drivers that are heavily weighted in the S&P and had a lot to do with the gains moving up to the big drop that we had, and they've had a lot to do with the gains that have occurred moving back up. The move today was a bit more broad, honestly, but then when you look at other sectors, as the market has continued to move higher, and while we've been going sideways over the past 5 weeks, some of the other stocks that really didn't have the kind of big moves off of the lows that those did were catching up. So there was a rotation. Some money was rotating around. So they felt like, okay, the easy money's been made off of those stocks, and now let's go find stocks and sectors that haven't moved as much. And that's how investment managers work. They look for sectors that are lagging behind. Obviously, you want to do a little bit of technical analysis and figure out why they've been lagging behind, and make sure that there's not a specific reason. But if it's just that they haven't been propelled higher with the stimulus money whatsoever or whatever, then those are stocks that you can catch on the reallocation of money. So same type of thing here. This stock has not enjoyed that run back to the upside. It's basically had a little bit of a move, but only in the formation of this symmetrical triangle off the lows. It's not enjoyed the move back to the upside. Maybe it was because housing was expected to be dismal, but there never was the expectation that private housing is more the commercial properties with companies are going to figure out that they can save money on rent by having their employees work from home. And obviously it's, the productivity question, and some people they'll want back in office spaces, but doesn't it make sense, or couldn't you make a pretty legitimate argument that maybe there's going to be a bit more office space available moving forward than there was before this pandemic started? That companies will feel like they can downsize. Maybe they still have an external office somewhere. It's just not as large. I think you can see where I'm going there. But the point is that housing, and this in particular, this stock has not been towed along, if you will, or dragged along from the big boys on the move off of the bottom. So my point here is I think that we have a long way to go to the upside here. And just closing this gap would be fantastic because we're already over 33.5% gain already. So anything to the upside from here would be great, and closing that gap would be fantastic. That puts the calls in the money when they look like they were just so far out of the money you'd never even get there before. And then when you factor in the fact that, wow, we just have so much room to move to the upside from where this stock was at one point in time. I know that's annoying. Sorry about that. When I move the charts, people tell me that they don't like it when I do that, but should just condense it down and show it to you. But you get the point. So those are the factors, and could prove out to be right, could prove out to be wrong. But I just wanted to share with you the reasoning of why, because it could have certainly made a case of, hey, that's a nice gain in a short period of time. You got a big jump up. You got a little bit of a gap here. You had a bit of a vol spike. Could have easily made a case to take that profit and move on. Didn't do it, so I wanted you to understand why. And maybe I'm wrong. Maybe it was a mistake not to do it. The time will tell. The market will tell us. Last thing is that you want to kind of look at the DMI. Well, you don't expect the ADX to be up here between these two directional indicators, because part of the reason that we find these consolidating triangular patterns is because the ADX is low. That's one of the factors that we look at. So the fact that it's not in between there, that part's not immaterial. But what happened on the breakout between the two directional indicators? They are far more responsive, quicker to respond to the movement on a day-to-day basis than the ADX is. The ADX is more like, turning an ocean liner. It takes a little bit of time for it to get and turn and move. But these two directional indicators, they're quick. They'll respond very quickly to movements in the market. And that's a pretty vertical cross, which is one of the things that you're looking for out of the DMI is, did the directional indicators cross more vertically, or is it more of a snaking sideways, channeling horizontal type of a crossover? So there was a pretty good vertical move there. So that plays into the mix as well. So with every position, you take all of the data that you can find, you analyze it, you process it, and then you make your decision based off of it. And sometimes you're going to be right, and sometimes you're going to be wrong. And that's just how trading works. Hopefully you're right more than you're wrong, and then you make money in the long run. So that's how it works. But I wanted to share that one with you. And then I wanted to show another one, Google. I'll share this one with you real quick. I think I need to switch back to this list again. So there's Google, which is an out-of-the-money butterfly. And Google did move to the upside today. You can see that there's the pattern there. Those are the three lines. And the reason that I put those three lines on there is because there are three legs to a butterfly. So you buy, in the case of an out-of-the-money butterfly, and for those of you that may have some familiarity with butterflies, but not the fact that you place them out of the money, most people are used to them being at the money. So it would have been right here, right in where the stock is currently trading, right there around 1,400 or so, and you would bracket where the stock is in a butterfly and expect it to stay in the trading range. That's how butterflies are done most often. We make them directional. We place them out of the money because they're far less expensive to do that, and that's why you can do multiple contracts on a stock that's trading at 1,500 and have a directional trade, which gives you much lower risk and much higher percentage of potential return if you happen to be right on the direction. Normally, when you have a sideways butterfly, you need that stock to stay within the wings. That's very important on an at-the-money sideways butterfly. when you place them out of the money and make them directional, stock doesn't have to it doesn't even have to make it to the bottom wing, let alone get in there and stay there. If it gets there and gets in between the wings, you just make more. But it just has to move your direction in order for it to become profitable. So we don't need it to get within these wings and then go sideways for a while like you do in at the money butterfly. So that was the setup, and you can see there's the DMI that you want. So we have the positive and the negative directional indicators separated. The ADX is curling up and it's above 20. Moving to the upside, it's between the two directional indicators. That's where the DMI is telling you, hey, there's some strength to this move. Unlike the DMI that I showed you on the S&P, right? That is not the same pattern that the S&P had. If the SPY had this, then be singing a whole different tune as far as where the potential could move. That's what you want if there's sign of strength. And the pattern doesn't look all that dissimilar to the market, does it? I mean, maybe percentage-wise, we're a little higher off the lows than the market itself has, but you get the point. It's a similar pattern, but a different DMI. So let's go take a look at Google on today's move, and I'll switch the chart. GOOGL is our symbol. So it opened well above, but almost to the point where it was a bit overbought because it left a gap. And I hate those gaps. So even though the stock still finished over 0.5% to the upside, over $8 to the upside, I'm kind of happy that we didn't leave that gap there, because I've been a little bit more concerned about that over the next few trading days. And so there's the DMI, and you can see that the ADX did still continue to move to the upside with it. And more importantly, the positive directional indicator headed back up. That's just as important as the ADX curling up. So the ADX showing strength, but it has to stay between these two directional indicators for it to give the strongest signal that's capable from the DMI. And then the red line, the negative directional indicator, or the selling pressure, moved down. So the buyers are in control. The ADX is showing their strength. So that one still looks good, at least from the DMI standpoint, to continue to move higher. And our target here is just simply to fill this gap. That's all we're looking for it to do, as I showed you on the original chart. Just come up here and fill this gap. When the gap is at 1,500, that's where the middle of the butterfly is. So we frame that move, and if we get there and hit the middle of that, then we'll have a very nicely profitable trade. And another beauty of an out of the money butterfly is the fact that time decay is at worst neutral, and the more time that goes by, it starts to actually become friendly, which there's not too many directional positions that have a fixed amount of risk. I mean, you can sell naked options and take on tons of risk and put time decay in your favor, but you're taking on one heck of a lot of risk to do that. But to have a fixed risk position and still be able to neutralize or even put time decay in your favor makes an out of the money directional butterfly make an awful lot of sense, and a position that we look for on directional trades when they're available. Trying to place a butterfly out of the money with that many legs isn't always available from open interest or the strikes there, or the pricing if there's a bid, because sometimes you have a zero bid, you have an ask price, but you have a zero bid, you're not going to be able to trade that. So the butterfly is not possible. But when it is, it's a great position to use. And I may have mentioned this to you before, but I've probably done more butterflies on Google than any other stock, any other single stock in my trading career. It's just a stock that tends to really work. I'm pretty sure that we looked at that in the Trade Scan series as well, that we looked at Google. All right, so that's first part of what we want to talk about. Now let's go ahead. I've run the search, and I told you that I would do this. So once we've gone through the Trade Scan web series, that we bring the results onto the screen and show them to you. And it looks like you're still seeing those, so don't need to change this over. So I expected this to happen, and as I mentioned to you, and I really don't pre-look at these ahead of time. I ran the search just before we started. Normally I would be doing this either super late this evening or in the morning tomorrow, as far as running the search to see what was potential, if anything, to look at. And obviously with a big update today, or like we had today, you would expect that you might have a few more results. 15 is a lot. That's about as many as you're ever going to see on the search parameters that we utilize. Just doesn't give you that many results normally. So let's go through and take a look at some of these and see if there's one that we find that we like to utilize as our case study for this week's TradeFinder. When you click on one, all you have to do, by the way, is after you've run the search, click on this little graph and it brings it up, and then we can click from here and advance it without going back to that screen every time. The indicators are shown up here, so it gives you what the result was of those individual confirming indicators. And again, with the trade scan, we just went through each one of these in depth, so you understand what they mean. We don't need to go through them again, but it just shows them on the screen on the fact that they all qualify with the parameters that we've put in that we're looking for to see if the stock has the potential to move higher. And then the only thing left to do is apply Elliott wave and see what the pattern is. So this one is still in a qualified downward 5-wave pattern. So you can see the wave 4 has corrected. We've moved to the upside in the correction. Remember, a corrective move is just a move against the prior trend. So we had a downward move here in the wave 3. We corrected to the upside here in the wave 4. So looking at that, we're already going to disqualify this one. Now, our confirming indicators are telling us that, there was some strength to this move. But the Elliott wave pattern is telling us that that could change and we could end up going back down here. Now, it doesn't really matter what becomes right in the end, whether or not it's the confirming indicators are right and this goes up and corrects enough to where it disqualifies the 5-wave Elliott wave pattern, or whether or not the confirming indicators flip over and the sign of strength that they showed runs out of steam with this move, because we're right at a 50% correction here. So probably going to have some resistance here with this stock, which could move it back to the downside. And just my point was, it doesn't matter whether the Elliott wave pattern is right or whether the confirming indicators are right. They don't agree. And that's one of the things that we need to have before we would consider placing a position or even looking to see what the options look like to create a position, is those have to agree. We have to have the confirming indicators giving us the strength that we're looking for, the potential for the move to continue that we're looking for, and then the Elliott wave pattern has to show that the current trending pattern within Elliott wave, whether it's a 5-wave pattern or a 3-wave zigzag, it could be either one, is moving in the direction of what the confirming indicators say. In this case, that would be to the upside because that's the search we ran. Doesn't happen, so that one's no good. We move on. They don't agree. APAN, I mentioned this before. I really don't like these REIT type things. This is a management thing. I'm not exactly sure what they're, if this is apartment management or housing developments or whatever. I don't really like these kinds of things. But boy, look at the pattern that we had here. First thing that you see here is that, wow, that was a great ascending triangle. And what happened? Thrusted out of that triangle. Classic Elliott wave corrective triangle. And we went right into, now this would be a little bit more of what I was talking about as far as what I would consider more of a flag pattern than consolidating in a symmetrical triangle. So we kind of had these highs and these lows right here. So that looks more like, like the American flag on a flagpole rather than a golf flag. I guess some golf flags are rectangular now too. They're not all in points. Talking about my age here, where some of the golf flags all used to come to points, not so much anymore. But anyway, that's more of a traditional flag pattern, but it is consolidation. So we had a ascending triangle, thrusted up, consolidated, probably going to make another thrust move. Now the Elliott wave pattern is telling you that in this correction, the fact that this isn't labeled, and it makes a lot of sense that it's not labeled because it's three-wave corrective patterns, right? I mean, that makes sense. That's why it's not labeled with a 1, 2, 3, 4, or 5. So we're probably in the process of correcting back up there. You don't want to guess that right now because when you have a consolidation pattern, they can break either direction. So you don't pick the direction, but you could certainly say that at some point in time, in the not too distant future, doesn't mean immediate future, could be down the road, we are going to come back up and test those highs. That's what the current LA wave pattern is telling you, unless something changes and something reforms. And I made the comment in the last recording about the portfolio manager that said the current market requires constant reassessment. And I think that that is, if you could come up with a definition of why Elliott wave, that's it. The market needs constant reassessment, especially with where we are now. There's no better indicator to change on a dime, if you will, if the market changes course. So there's no reason to stay stubborn and stick to your laurels. Go with the market. So that one would be interesting more on a strangle side than a directional side. So, I mean, we can keep that one as a potential. I have no idea what the options look like on that. Not even familiar with that company, to be honest with you. But let's just go to the next one. Get through these 12, and then we'll get to some questions. Arch Resources. I don't know if that's commodities, what that is as far as what the resources they're utilizing. But you can see the wave 4 moving back up. So this one would be a good one. Obviously, the confirming indicators are telling us there's strength to that move, but the Elliott wave pattern is telling us that there isn't much further to go. And that could change. There's a gap up here. Maybe that gap got filled. Low of 43.21, high of 42.96. So not quite, but almost. But just doesn't look like there's a whole heck of a lot of move left here. That's what's expected. Now, the stock could continue higher. We've had that happen before. But as far as creating your trading plan, you go with what the technicals are showing you, and they're showing you a potential move right back to here, and then that could be it. So it could go higher, it might not, but the higher percentage movement of what Elliott wave is giving you, putting the percentages in your favor, is telling you that we're going to probably run into some resistance right here, and then after that, who knows? And at 23%, that's a fib level on this corrective move. So, something else to consider is Elliott much preferred a 38.2% correction. So he would likely make a case that that whole thing was an impulse move, and we could correct all the way up to, if you wanted to put a 38.2% fib corrective level on there, then look at that. Isn't that, it's fascinating when that works. And it just, the math of the markets continues to amaze me even after 25 years. But look where that 38.2% corrective level is. If we were to bounce back up to the 38.2% corrective level, which in Elliott's mind would be an actual legit correction, it exactly fills that gap that we just said wasn't quite full yet. And it's amazing, isn't it? I mean, it's the exact point where that gap gets filled is where the corrective move could be. So just for the heck of it, out of fascination, I'd be curious to see if there's even options available for something like that. So Arch is a symbol. Be curious, if nothing else, to know what they do. Not that big of a deal. Spreads are kind of wide. Open interest isn't very high. Not really very ideal for putting on a trade. The open interest is just not there. You're going to be trading against the market makers, which means you're going to get the worst price in and the worst price out. It doesn't mean you can't get filled. Low open interest doesn't mean you're not going to get filled. It just means you're going to be trading against the market makers, and you're not going to be splitting spreads and doing things that we have become accustomed to doing as far as getting better pricing. So with that, let's just move on. But from a technical standpoint, it'd be fascinating to watch and see if we go up, hit that 38.2% level, fill in that gap. That would be fun to watch. ASML Holdings, Another one, these things that I don't know what they are. They're baskets and management companies and REITs and stuff. But we've done what we're supposed to do in this one. So the confirming indicators may be telling us that we could go higher from here, and you can make a case for an ascending triangle. Not a lot of touches of the horizontal resistance line, but certainly we're right there. You can make a case for it. The ADX is moving to the upside, kind of telling you that this one, at least from the DMI, that this is going to be an upside breakout. But I say this over and over and over again, and I say it because it's extremely important. It's imperative to know that when you have a triangle, it can go either way. And I know there's other Elliott wave rules that triangles within a wave, the breakout is likely going to be a particular direction, but data just doesn't prove that. Data says it's a flip of a coin. So with that standpoint, I wouldn't want to put a bullish directional trade on here. I would want to do a strangle and cover both the upside and the downside, even though the DMI looks like this is getting ready to blow to the upside and we make new highs. There's no question. You break above that, you make new highs, then we're probably off to the races. But a $320 stock is probably going to be a very expensive strangle. That's where you would get into more of the twin butterflies that we've talked about in the past, where you put one at the upper target and the lower target and let the profit from one offset the loss of the other. And you go from July to October. There's no August or September, so that's that one cycle that we've shown in the past that we don't like. Very expensive, as expected. Not a whole lot of open interest. The butterfly would be, because of the width of the spreads, not impossible, but not favorable either. So just move on. But another one that you could put on a watch list just for an educational standpoint and say, hey, does it break out? If it does, is it an upward breakout, or does the resistance hold and it breaks to the downside? It'd be fascinating to watch that and see. So that's an ADR. So that's something, it's a foreign company trading on the U.S. exchange. Somebody can Google and figure out what that is. Now, here's something that's a little bit more interesting. So DT, where we have our confirming indicators, we have a really nice Elliott wave pattern. Look at this. So there's your one, there's the two, very classic 1, 2. Now we're in a wave 3, and we obviously have the confirming indicators that are giving us a signal that this one is likely to continue. You've got a really good, mature, but good DMI, meaning that we're not only just above 20, which I like to look at, we're above 25, which I feel is a slightly conservative level, but one that's taught with the DMI. We're approaching 30 already. So a good part of this move is in, but you can see where the target is. Where the target's up in here, so where we're at 37.28. So we could go somewhere between 42 and 45. And with this move, moving averages, I don't think that's overbought. It's not. This is more like what we're looking for when we're running the search and going through the indicators, so that we have our confirming indicators that are telling us that we have a strong pattern, and then we have the Elliott wave that's confirming. So now you've seen the difference. So this has been a really good, we've had a couple really good weeks in a row here. If you're really interested in learning, because I know you're not here just to hear me talk. I like to listen to myself talk, but not everybody else does. But if you're really here to expand technical based knowledge, we've had a couple good weeks in a row where we've had a variety of things to look at that can help broaden and advance your technical trading abilities. But that one looks pretty good. Let's see what the options look like on here. I've heard of this company, but I don't think I've ever traded it. So I'm not super familiar with how liquid or lack thereof the options are. So we have July. We do have August options. Not super liquid. The spreads are wide, but not horribly wide. You move down to in the area of the 30 delta for our directional trade. The 45 strike August call is right there at a 33 delta. It's got over 100 contracts. So it's not hugely liquid, but at least there's enough there. That one's not awful. It's not the most liquid as far as the options. The spreads are a bit wide. It's always hard after hours to know, especially when the VIX is above 20 like this. You know they widen the spreads when we close, because with the volatility the way it's been, the market opened up 500 points today on the Dow. So the market makers want to lessen the risk as much as they can. So spreads tend to widen after hours, after 4 o'clock. I don't know if people are aware of it, but options actually trade till 4:15 Eastern time, even though the actual market closes at 4. Options still close at 4:15. I know a lot of people that have gotten burned by that, by putting on where they had credit spreads or naked options where they thought that they expired out of the money and that they were okay. And then they got a margin call and they didn't know why. Well, it's because that between 4 and 4:15, the options moved, and what they thought was an out of the money option at the close ended up in the money. And so they either got an exercise or a margin call, whatever, and they had no idea that options actually don't settle till 4:15. So anyway, just a piece of information that some of you may not have been aware of. I'm sure a lot of you were if you trade options. But my point here is that they can widen the spreads after hours to keep from having too much risk of some sort of a significant move up or down on the open the next day. And coming off a big day, there might be a concern there. The futures right now are up 6 points, trading right at 300 again on the S&P, or 3,000 on the regular market, but it's the futures, so it'll be pretty close. So it looks like we're going to test 300 again on the open unless something changes, but there's a long time to go between now and tomorrow's open. But that one, I'm going to leave that one because that's a potential. About halfway through, I'll pick up the pace here a little bit so we can get to some questions. Look at that oscillator. So with some serious short-term momentum there. Going back and look at the DMI, that looked good. See that big spike up there in the positive directional indicator? That was good right there. So that was giving you indication, even though we did come back down, we got overbought. This is my point that I've said so many times, that no security in any time frame gets very far away from its 10-day moving average. See that? So we know that we've moved up from here, but where did it go directly after this? Directly after this, we came back down. Came back and touched that 10-day moving average. That's what I'm talking about when I say over and over and over again, no security in any time frame gets very far away from it. It was a big, strong move, but came back down to that 10-day moving average. And then now we sprinted right back up. So that it just happens over and over and over again. If you only take one thing out of any of the videos, stuff that have done, what we at Elliott Wave Options have done as far as education over the past 2.5 years, that's one rule that you can take with you and make some money off of. So that looks pretty good. The Elliott Wave is in a wave 3. We're consolidating a bit here. I've drawn cruder triangles than this, so it would be amiss to say that you couldn't make a case for not super well formed, but crude ascending triangle right there. And I know it's real easy to say it's in a wave 3. The confirming indicators are saying it's strong. It's breaking to the upside. It may very well break to the upside, but I'm just saying that Elliott says, pay attention. It's a corrective pattern, takes precedent, and you have to respect the fact that it could break down as well. But all in all, not a bad pattern. If you were to put a bullish position on, just know that you're kind of playing with fire here with the triangle if you're picking an upward direction on it. So maybe we'll do another vote on this one, which one we pick this week. Since there's a couple. Wow, look at that DMI. Holy cow, I hope the Elliott Wave pattern is confirming on this, because that looks great. That looks really good. And frustrating. I mean, this one is very close to violating that 4. Very close. 65 is right on the cusp. If you get towards 70, then I'm like, all right, we're going to 78.6. We're too far away from the 61.8% level. 65 to 62, too close. That's too close. But if this wave 4, if we move past this enough to where this pattern becomes disqualified, which the DMI is suggesting is exactly what's going to happen, then here's your target. That's where it's going. It's going up to 35, and we're only at just under 28. That's a nice move. Still to go there. So, these are the things where we see a couple that are right on the fringes of the rules, and it's easy to say, it'll be all right. It's going to do what we want it to do, even though you know that you're not specifically following the rules. Well, when you start doing that, and you start doing that when you gain confidence, when you're having a good run, you've had several successful trades in a row, or maybe you're 5 out of 7 on winners, something like that. So your percentages are in your favor. You've been doing well. That's when you kind of start to bend the rules a little bit. You start gaining that extra piece of confidence and thinking, yeah, this is exactly what's going to happen. And as soon as you do that, what do you think happens? The market jumps back up and reminds you who's boss. That's what happens. The market says, yeah, you might think you're doing well, but just remember, you violate your disciplines, and we're going to show you what happens. So as good as that DMI looks, and they don't get much better than that, really don't. Because you can even see this crossover right here, pretty vertical, came back down. There's the kiss. If you, again, were in the trade skin, I talked about this happens a lot, where it looks like their two are going to cross, but they don't. They come together and kiss and move back apart. That's exactly what I was referring to there. And then the ADX is curling up, and it's between. It looks great. The DMI looks fantastic there, but the LA wave pattern's not violated enough yet. It's too close. So you could put that one on a watch list. I wouldn't be against that. Put it on a watch list. If we get up here towards 30, that's probably going to be enough. You still have 5 points to go to the upside on a $30 stock. So just under 20% move. Certainly worth putting on a position at that point. But to do it today, right now, you're bending almost to breaking the rules if you do that. So I'm going to pass on this one. But if you wanted to keep it on a personal watch list, if you've been keeping track, I hope you have. I hope you have been keeping track of what we've shown since we started the TradeFinder web series, because the results have been good. Monster Beverage has Tiger Woods as their one of their spokespeople now. There's another wave 3 like that. Come on, let's see a good DMI. There's a good DMI too. Now we're talking. This one's going to be difficult to turn down. It really is. Look at that spike in the CCI. It's unusual, but it's there, and there's plenty of room to move out of the CCI. Money flow is good. That looks really good. Fingers crossed on the options. This one will be tough to beat if there's any liquidity at all in the options. Man, it's not great. This is the difficulty of trading. There's so many pieces. If people wonder, why don't you put on more trades? Because you just don't throw caution to the wind. There's so much to analyze. I mean, we're only looking at charts, and we're not even going that in depth in the charts. We're skimming over a lot of stuff because it's already incorporated into the searches that I'm doing. But then there's so much to do on the option side. There's just as much when you need to analyze the volatility and look at the Greeks and where they are, and just basics like the width of spreads and open interest. Those basic things. There's as much stuff to do on the actual option side as there is on the technical side from the charts before you can put on a trade. And as I mentioned previously, we're looking for reasons not to put a trade on, and there's a long list. And if you go through that long list and you can't pick one of those to not put on a trade, that's when you put a trade on. But any one could trigger a no-go along those lines. If you went out to September, There's a 34 delta on the 75 call. That's not bad. It's got over 200 contracts. That's actually pretty interesting. The spreads are wide enough to where it would make doing a spread challenging, but a September 70 to 80 spread is attractive as well. Just knowing that you're a bit wide on the two spreads, so you're going to have to recover that. But you would be near 500 contracts on both sides, the buy and the sell of the spread. So that's attractive. And your delta would be around, that's actually not a bad trade. Yeah. So the spread is the trade there. That looks awfully good. So unless we find something here real quick, and I'm going to skim through the next ones very quickly, unless we find something earth-shattering, that's going to be I'm not going to put it to a vote. It's too good to not pick that one. So let's pick, we get Phillips 76 on there, so I definitely want to look at that one because oil made a comeback from the depths of despair where it looked like they were going to pay you forever to take oil off their hands. New York Times, wow, print media, holy cow. No five-wave pattern. We're near the recent highs. Crude ascending triangle, maybe. This triangle was better. That's the one you wanted to trade right there. Look at that. There's your trade right there. See the breakout from that triangle? That was so much better than what we have now. Pegasystems. So your target is right here. Just over 100, and we closed at 93.68. Decent DMI a little bit earlier. Catching this one just before it hits the 25, but it's above 20, and it did go below 20 back here in early May, so that's good. I prefer it when the ADX comes from underneath 20. Again, I hate to keep mentioning this, but if you were in the trade scan, you understand that. You know why we were talking about that. But this looks good. And moving averages. Wow, lots of room there. That actually doesn't look too bad either for a continued move. So it's about a 10-point move. Not hugely good percentage-wise, but not bad. No options. Has options, but there's no liquidity. It should be specific. Forget it. There's no trade there. So there's the Phillips 66, and there's your red flag right there. So the confirming indicators are telling us there was some strength to this move, but we're right at the 61.8% fib level, and that's why we're having trouble there, because it was here too. So it's gone nowhere since April, since it hit that level. So it bounced down from the 61.8% level. It's right back up to it. Still there. Definitely not an upside trade to that yet. At this point, at best, you come up and maybe close those gaps right there. I don't see a long-term move to the upside. Not right now out of that. DMI, if it follows through, could change that pattern, but that's why it's going so sideways. It's having trouble with that level. Wouldn't want to do anything now. Thor, just from the name, there's a cool name. Traded this one before, but that's already reached its target too. Look at this one zigzagging to the upside. And just use our zigzag tool real quick here. And then another one here. I'm making a mess of this chart with all the lines on it, but lots of zigzags there. That's awesome. But it's at its target, so I'm just wasting time. Let's go on to the next one. VC, 65%, still the same problem that we had before. Is it this one? No. Yeah, one of the ones that we had before, I guess I clicked off of it, that was at the 65% level. It's too close to 62. It's not far enough to disqualify this wave 5 pattern yet, so you still have to respect that. So they're not in agreement, so we move on. Winnebago, you know, for those of you that like fundamentals, for whatever reason, I don't know if people have decided that they're going to buy a Winnebago and just travel with their own family now instead of get on a plane or a train or a cruise ship or whatever. But motorhome sales are way up. Not something you would think about. You'd think that, well, that's a luxury item, and probably in a rough economy, that's not going to be doing very well. Not so. Sales have been fantastic. So I don't know if people are using them for homes or just a motorway to get away from the virus or what, but this is supported by fundamentals. For those of you that really like fundamentals, the problem is it doesn't look like there's a lot of move left. Here's another one with a lot of zigzags. We could spend a whole time, and we're going to do that. See, drawing these zigzags here, the next web series on Elliott Wave, we will go through the mechanics of this and what that means. You have double and triple zigzags, not just the 3-wave ones that I talk about all the time. As I've mentioned, there's so much more to Elliott Wave than what people really think when they just view these circles. This is almost a crutch, having these circles on here and just watching those. There's so much more to it. And these are all zigzags here, and they're all hitting fib levels, and there's specifics behind these. And when you see multiple ones together, that's when you can layer trades. We talked about layering butterflies at one of the webinars that I did. There's so many of them, I don't remember exactly which one we were talking about, and maybe it was this TradeFinder, but that's when you can do that. When you see that you have one of these patterns working, and when you have a stock that you know is doing this, it's impulse correction. I mean, it's classic. This is what Elliott identified. This is what he saw in the markets. This is why Elliott Wave theory exists in the first place, because he saw stuff like this, and he felt like you can identify these, and it's common enough that when you find it, you can trade it and put the percentages in your favor, which is all it ever has been. So we'll go into more stuff like that. We'll dive into really labeling these things and what that is, because most people look at that, that's an uptrend. Yeah, well, what is an uptrend? An uptrend is a series of zigzag patterns. That's what an uptrend is. Double or triple, how do you know how far it's going to go, or the extensions? All that stuff comes into play. But the bottom line here is that we've had the better part of the run. The DMI looks great, and that one could be one to put on a watch list. I love the fact that we're going through the multiple zigzags, so it's just classic stuff with the impulses and corrections. If we broke above here, that would be quite interesting. That's fascinating, isn't it? I mean, go back and look with as strong as the markets, I did it again, sorry, but as strong as the markets have been, and as strong as they were before this pandemic hit, and then we're right back at those highs. And if we break that, we're going to go to like all-time highs. Amazing stuff, really, with what's going on. But that would be another watch list stock to look at. And you break above there, it's likely off to the races, especially with the way that DMI looks. There's plenty of room there. And look, even with the DMI above 30, so it's not quite to what I would consider mature yet, but getting there. It's pretty close to it, like the one of the other ones that we looked at. But look how good that separation still is. That's pretty amazing with an ADX that's moving this far and is above 30, and the separation is still good. That's why I'm saying that it's not that mature yet. Looks really good. So from that standpoint, there's a reasonable chance that this breaks those highs and takes off. I would want to keep an eye on that. Just no way I'd want to put a trade on it right now. Just, you would have to, you know, it's Missouri. Show me. It's got to break that level first. Here we go. Well, this is going to be challenging here. This is going to be another one that could be a good one. It's in wave 3. It's not a hugely priced stock. Yeah, see, I've been running my mouth on Monster Beverage, but this is pretty darn good too. The only thing that we could give the nod to Monster over this is this is an example of how I set the search up to catch this ADX before it gets to 20. See how it hasn't crossed 20 yet? That's the rules. It has to break above there. Now it's closed between the two directional indicators. There's fantastic separation between the two directional indicators. That's awesome. That's a great looking potential setup in the DMI, but it's got to get above 20 first, because look what happened here. Boom, and it kicks back down. That's why that rule exists. We got to break above that. It looked like it was going to do it here, and then it didn't. But, you know, it wouldn't have hurt you too bad because it just kind of kicked down a little bit and then went back up. So where are we? 32 to 37, 38. Not as big a move as I thought initially just from looking at it, but still enough of one to where it would be. That's really good too. Both of these are really good. Let's see what the options look like here. And this has been a very popular stock with the stay at home, but I don't really think that when people go back to work, the technologies can still be used there too. It doesn't have to just be utilized at home. August, because it's newer, doesn't have great open interest, but July does and October does. So the only reason August doesn't is it just hasn't been trading very long. The August expiration month, so the open interest I think will come in. The spreads are tight, so yeah, that'll show up. So in August, spread straight options aren't that expensive. They're really not. So you do either one on that one. I think the trade is a spread on the a call vertical debit spread on Monster. You might go with August straight options on this one would be a consideration. Both of those look really good. So I will put this to a vote. You know which one I'm going to pick, but now I'm not going to do it to a vote because we're violating the rules. Never mind. I'm not going to do that. Sorry. I'm sure the support people like, what the hell are you doing? You keep talking about doing a vote, and they're probably queuing it up, and then I changed my mind. So I apologize to the support guys for that. But it's not above 20 yet, and that's a rule. So let's not, I'd just be violating everything that I tell you is to wait and follow your rules, follow your system. So it looks great. It makes you itch and want to jump in because you're afraid that if you wait till it breaks 20, then there's not enough move left, and that's what happens. But that stuff gets you in trouble. When you bend the rules for specific things like that, it may very well go to its target and look back and say, well, we could have done it. Maybe after tomorrow, then the ADX is at 20. We just wait one more day, but follow your rules. Monster's good enough. So that's going to be our case study for this week is MSST, Monster Beverage. Right, Tiger's back on this one. I'm going to put debit spread down here. You could do straight options on it, but I think the spread looks really good on that. So there we go. Oh, gosh, it's been way long. Apologize for that. Slack has earnings on 6/4. Cool. Well, then we could change this one to that's a speculative position. You would be, it's okay from time to time. I still think you want the ADX to be in your favor. I'm never afraid of trading through an earnings report because I just think that more often than not, the stock moves through earnings where the pattern was telling you it was going to go anyway. Not always, but nothing's 100%. And you'll find one where it reverses you and say, well, see, we shouldn't have held it through earnings. There's an exception to every single rule, and nothing's 100%. But it's been my experience, and that's all I'm sharing with you, is that more often than not, the earnings report is just a catalyst that moves the stock along the direction that all these indicators have been already showing you. And so the earnings report coming up doesn't worry me. If you wanted to view that as a speculative position because of the earnings, then go ahead. It doesn't frighten me. What I'd rather see is that I would love to see that ADX get above 20 before the earnings, and then it'd be fine to go ahead and do it. Now, the only thing, here's one consideration. This would be legit. Now, you have seen, right, we're a very strong stock. It's moving well, goes into an earnings report, and the earnings report's pretty good, and the stock backs off, right? Sometimes it explodes to the upside, sometimes it backs off, and you think there's no rhyme or reason to how the earnings report is going to be received, right? Well, it was a good earnings report. Well, they expected it to be even better. You hear all that crap all the time. But sometimes you have a nice move, the earnings report sells off, but then it turns right around and goes back. So if you are a little bit nervous about holding directional trades through earnings reports, do a spread. So if you put on the long call vertical spread and the stock backs off on an earnings report, buy back the short call because that will have done well on the way down. Maybe add more to the long calls and then let it ride it back up. That's a lot less risky than just buying a straight option if you have an earnings report coming up and you're worried about the risk factor of the earnings report. Thanks for that, though, John, on looking at the earnings report. Where's my hat? I don't wear the hat in the TradeFinder, but it's right here. It's right there by the table. Yeah, I see that the support guys have been putting those symbols up. It must be tough to see on your screen. So thanks for doing that. Appreciate that. Not a whole lot of questions. Yeah, Larry, that's a great question, right? If the options don't close till 4:15, how come we can't enter orders and close them out between 4 and 4:15? Doesn't seem fair, does it? But that's how it works. That's how it works. Now, I'll say this, if you have a broker that's working an order for you, they can do it. They can keep working it with well, we don't have floor guys anymore. Actually, that's an interesting point. I don't know with it all being electronic now. I probably should go back. I should take a look and see how they're doing that now. Settlement wasn't until 4:15, but now that there's no floor people, just happened to think about it. I don't know the answer to that. But prior to that, yeah, you were just having to sit there, and if you were right on the line of being out of the money versus in the money, just nail biting time till 4:15. Looks like a lot of you questions have been answered. We'll look at Tesla real quick, and then we'll wrap it up because, as usual, I've run way long. I thought this was good, though. I hope you found this interesting. I think we had some good things to chat about here. So there's Tesla, and yeah, the triangle's still there. And we talked about this before, and wouldn't you absolutely love to put a strangle on here? Be fantastic. Look at that. Well, you talked about space, which is another company, SPCE. It's not SpaceX though, but with Tesla, you have SpaceX, and I don't know. I mean, y'all are probably aware they're going to attempt tomorrow afternoon at 4:30 to launch humans back into space again. Pretty cool, especially on the Space Coast. Big deal around here right now. It's been over a decade since we've had U.S. citizens launch from the U.S. Into space. We've had astronauts going up in the Russian rockets and stuff to the space station and everything, but not our own right here from the U.S. So it's been a while. So all eyes are on that. Hopefully, fingers crossed, the weather's going to be okay. It's 50-50, by the way, on the weather. So coin toss on whether it's going to happen or not, but that's something cool to think about at 4:30 tomorrow afternoon. Just fantastic. Just, if you wanted to do the double butterflies, the double out of the money butterflies, and out of the money call butterfly up here, out of the money put butterfly down here, that's the only trade really that you would want to do on this. It's just an amazingly good pattern. Just ultra expensive to do because of the stock. So sometimes you just have to sit and watch. and wait. But my point was that this is kind of like that blast off pattern here, getting pretty close. And that's what I'm talking about when you have it's the launch pad effect, when the stock goes sideways and it goes dead sideways for a while, and quite often it jumps to the upside. That's what we had on the VIR that we did for the subscribers. We had a bullish position on VIR, same exact pattern, almost identical pattern to this, by the way, which exploded to the upside. And see, that one we took off, and that was the right move to do. So here's what I was talking about on taking a position off versus waiting. Look what happened here. Is this going to happen to MHK? Maybe. And then might look back and say, well, how come you took off VIR and you didn't MHK? Different story, different dynamic. Totally, this is so speculative with biotechs and the race to get the vaccine and everything else. And so that's what I was talking about. When you have the gap up and you have the spike in vol, we took that one off that day, and it's just come right back down ever since. That was the absolute right move. Is it going to be in MHK? Well, I guess we'll talk about that next week and see if I'm got my tail between my legs or saying, hey, we did the right thing. We'll wait and see. But that's trading. Thanks, everybody. Appreciate it. Sorry to run long, but appreciate your attention and spending your valuable time with us. Hope all your family and friends are safe. See you next week.